Hi, this is Shane with the Rational Trader. It is October 6th. We're going to talk about, there's one issue that we're seeing in these really fast volatile markets I want to talk about with the members. And then we're going to talk about the what I'm going to release this weekend, which is related to refinement to how we look at low volume nodes. And then we'll go over kind of what the release, how that's going to be packaged, because it's fairly big in terms of the change to the existing system. All right, so let's get started. Let's start with the auto order management. So if you have a system that's going to take trades for you automatically, you have to have some way. If you're using limit orders, you have to have some way that the system will cancel that order if it doesn't get filled. So the first thing is you need to have the logic that decides when are you going to cancel that order, and then you have to have the ability to actually cancel it. Okay, from a technical perspective. All right, and so if we take this case, for example, right here, let's say, that's a short. The way our system works, the next down bar, it's going to place an order. If I tell the system, place your order up here at that price level, that order is not going to get filled. Okay. If I place it here, it will, and there's no problem. Okay, but what I need to describe this issue that we're having. Let's say I'm being super conservative and I tell the system, place the order, 8 ticks off the edge of that bar. Okay, this is the limit entry offset. That order is not going to get filled, but we can't just leave that order sitting there forever. All right, we have to have something that says, okay, we're not filled, cancel the order, let's look for a new one. All right, and so the mechanism in place that manages that had to be written in a custom study to get it to work. Okay, and that custom study is called TRT order management. It's right up here. All right, and in TRT order management, just look at the top two. It says bars till canceled, enabled, yes or no, and then how many bars. And what this means is that if I place the order on this bar, it's actually this bar. If I'm not filled within 2 more bars, cancel the order. Okay, so that's that 1, 2, and then cancel. Okay, so that seems all very logical, right? All very simple. The actual technical implementation of doing that is really complex, and the reason is that the system that places the orders is really it's a different part of the software, the Sierra chart software, than the part that's drawing the charts. Okay, and there are other computers involved. There's the Infinity computers or your broker's computers, and then there's the exchange computers. Okay, and so what actually happens is you place an order. Okay, I'm gonna kind of tick off the things that happen here. You place an order. Okay, that order goes to the broker and is evaluated, and it's either accepted or rejected. If it's rejected, a message comes back. If it's accepted, it goes to the exchange computer. The exchange computer either accepts or rejects it. If it's accepted, it goes back to the broker computer, who then sends that information back to your computer. So there's these 5 links in the chain that occur. Once it gets back here, once you get order accepted, basically, then the order appears on your screen. Okay. The issue that I'm seeing in recently, because the markets are moving so fast, is that this takes time. All of this takes time. All right, it has to go out and it has to come all the way back. Normally, it happens in it's sub-second. It happens so fast. It happens actually in milliseconds. you would measure it in milliseconds, and we don't notice it as a problem. But while all this is happening, okay, so while the pink arrow is happening, and while the okay, now I'm irritated. While the yellow arrow is happening, time is passing, okay, and other orders are coming in to the exchange and to the broker computers, and the price is moving, is my point. And so it is completely within the realm of possibility now that while this is happening, the conditions occur for that the order should be canceled even before it's been placed. Do you see? So what the system will do that, you'll see it. You'll see it order place, and then it just immediately goes away. All right. There's another case that looks a little odder, where the order is placed, but but this bar is still drawing, and then it gets canceled immediately, and it seems like that one should have been okay. All right, and the problem that we're having there is it's related to this, in that when the markets are moving really fast, the start times of these bars can be very, very close to each other. And without getting too technical, the way that we figure out, well, which bar does this order belong to, is by looking at the timestamp on the order and comparing it to the timestamp on the bar. Okay, so the timestamp on the order is at this point in time. All right, so all these 5 steps occurred, and then then it came back, and we have an order with a time on it. That time is not the same as the time when you placed the order. Time has passed. Okay, and the problem is that when the market's moving very quickly, as the system tries to figure out, well, which bar does this order belong to, it can fit more than one bar because it's moving so quickly. And so what will end up happening is these 2 bars would both qualify as bars that the order could belong to, and you'll see the order place and immediately cancel. And you're like, no, that's just not right. That shouldn't happen. All right, but that's what's going on, is that there's a timing issue because the market's moving so fast. Okay, it is not at all easy to solve. We've talked to Sierra Chart, and the basic reason is that the granularity of time in the charting system is greater than the granularity of time on the exchange computers, which is I don't think it's down at the nanosecond, but it's much lower. And so because of that, you can have this condition where you can't figure out which bar does this order belong to. It's only a problem when the markets are moving super wicked fast, like we've seen recently, because the volatility is so high, the range is so high. There's not an easy solution to that problem. It may very well be a feature, not a bug, depending upon your point of view. I want to make you aware of it. It's a feature because if the market's moving that fast, you probably shouldn't be trading. It's a bug because it's not working as intended, as expected. It's not a severe problem because it doesn't ever hurt you in terms of placing orders it shouldn't place and anything like that. What does happen is occasionally you'll get an order placed and it immediately cancels and it's not obvious to you why. Well, why did that cancel? That's what's going on. The market's moving really fast. Okay, I'm still thinking about it, about how to solve it. Again, it's not an easy solution until Sierra Chart comes back and gives us a finer level of time as it's associated with each of these bars. There is something you can experiment with. Okay, I don't recommend doing it. You can experiment with it. And that is, there's another setting in here in order management called bars till cancel. I'm sorry, called ticks till canceled. And then there's a yes or no. I've never actually used it. There's a yes or no, and then there's a number. All right. This says, if I made this yes, this says, and this would have to be no. If I get 8 ticks away from my order, cancel it, as opposed to counting bars. All right. So in this case, if I get 8 ticks away from this order here, you would cancel it. All right, as opposed to looking the next bar. All right, I've not studied if that's a good idea or not. Actually, the programmer put that in because he thought it would be a good idea, and he kind of just came with it. I've never used it. So if you do decide to explore that, you want to definitely run it in Sim as something that you're testing. As it stands right now, there's nothing much more I can do other than just recognize that I might have orders canceled that I really don't want canceled, because because of the mismatch between Sierra Chart's level of precision on time versus the exchange computer's level of precision on time, and the fact that the markets are so crazy. Okay, my attitude is more, I'm kind of not going to worry about it too much, because when the markets are this crazy, things are almost random anyway, and so it can work for you or against you. A problem that we have as humans is we will recognize those times where that it happened and it kept me out of a nice trade, but you'll ignore or not notice the times where it saved you money because it would have been a losing trade. Okay, so just be aware that if you see that happening, that's what's going on. And no questions. Okay. All right, so we're going to talk about next agenda item, which is low volume nodes. So let's take the same chart here. And what we've done here with volume profile is, let me go back more towards the beginning of the day. Though this is actually a really good example right here. The volume profile, can I even see it? All right. Let me go back to here. So let's look at this profile right here. All right. So this will be a quick little volume profile. Summary. If you see these gray bars in the background, these ones here, all right, and it kind of looks like that, and then that. You see those gray bars in the background. These represent the volume of contracts traded at that price level. Okay, so you can see that it often makes what's called a normal distribution. For those of you that are mathematically inclined to remember that, all right. In that, this is like a bell curve. Okay. You can see here today, on this particular day, there was another one here, another distribution, another bell curve distribution. All right. So the market spent some time down here, and then it broke out, and then spent some time up here, and then it broke out and spent some time up there. Okay, so this is actually a very complex profile here today. And what we're doing is we're using this information on how much volume is traded at the different price levels to help us make a decision on whether or not this is a good location to find an entry. Okay, and then if we decide that it is a good location to find an entry, then we unleash the machine learning system to make a prediction. Okay. The two locations that we are most interested in are at the edge of the profile and at what are called low volume nodes. Okay, so the edge of the profile, if we just pretend that this is the only profile on screen right here. Let's try that again. If we just pretend that this is the only profile on screen right here, you can see that there's a the bulk of the trading has occurred between these two blue lines, and then there's a little tail up here and a little tail up here. All right. And in between these two blue lines is where most of the trading has occurred. All right, this is called the value area. And so what we want to do is recognize that, well, most of the trading has occurred in this area. All right, so if we get up to the edge, if we get up to this spot, all right, or this spot here, that's a good place to look for a trade, because the market has to make a decision there if we get up to the edge, because it's either going to rotate, if you're up here at the high, the value area high, the market's either going to rotate back in, either back to the middle or to the other edge, or it has to decide, okay, now I'm going to break out of this profile and we're going to go off and discover new prices. Okay, so the fact that a lot of trading has occurred here, what it means is that there's a lot of buyers and a lot of sellers who both agree that this is a fair price to do business at. Okay, if we break out of the volume area, then value area, then we don't have that agreement. We're looking for that agreement now. Okay, so the price is no longer in a state of equilibrium, and we're now discovering where is the new equilibrium. Okay, where is the place where buyers and sellers agree that this is a good place to do business at, and then you'll see volume build again. And so if we were looking at this profile earlier, I don't remember exactly how this day played out, but you can see that there was a time down here where the buyers and sellers agree. There was a lot of trading that occurred there, but then it broke out, and we started to find agreement on price up here. Okay, and then it actually broke out again. Okay, so the nature of the markets are like this, where you've got the price is seeking a location where both sides agree this is a good place to do business. All right, we don't want to be anywhere near that location, because the price tends to chop around and be ugly and sideways. And so let's go back to the beginning of this day here and talk about how we represent that on screen and what that does for us. This day was really incredibly active. 6:30. In fact, Thursday would be better. Let's go back to Thursday. Markets are so crazy right now. Okay, so here's 6:30. All right, so what you see on screen is 6:30 is right there. It's that green line. What you see on screen is value area high. This is that blue line, and it's going to track throughout the day as the volume trades. All right, and then this is the value area low. It's going to track throughout the day. Okay, so as we start the day, the value area high is up here at 76.30.75, and the low is at 76.12. That means 70% of the trading has occurred between these two levels, starting at this point in time, starting from yesterday's electronic open. Okay, 70% of the trading, and this is the value area. Okay. The blue dashed line is the price level where the most trading has occurred. It's called the point of control. The most trading is the point of control. So as you can see, on this particular day, we start off with the point of control very near the value area high, which means that profile looks kind of skewed, right? There's been a lot of trading. There's been a lot more trading up here than down here, all right? So it'll look, a little lumpy. All right. Now, all we care about as traders is, one, stay away from this point of control, because it's a place where the market tends to thrash around. A lot of trading has occurred there. That's my target place. It's not a place I want to enter. All right, and the edges are here and here. These are very interesting places to me. All right, and so when I get down to the edge, I want to start making predictions. That's what these orange bars are. The way I'm representing the location to find something interesting, to look for something interesting, is the bar is orange. Okay, so down here, these bars are orange. They're right on the value area edge. The market's got to make a decision here. Am I going to rotate back up, or am I going to break through? Okay, so here in this case, the market actually breaks through and looks like, okay, here we go. We're going to go off and find new prices. It bounces back, and this is very common. It runs right into that edge and gets rejected and continues lower. Okay, so you can see why we look at this as like, okay, this is the place, this is the spot where we want to look for entries. Okay, then what we do is we let the machine learning system then kick in. Okay, now a question: the astute observer might notice that these bars are not orange, even though they're right on the value area high. Okay, and these are. Why is that? And well, the answer is simple: is that we want to stay away from the point of control. And here, at this point, right from at 627, the point of control shifted up to here. And as soon as it did, you're now too close to take a trade, even though the value area edge is right there. Okay, so we never want to enter at the point of control. It's too noisy. The market tends to thrash around it. So up here, this looks good. Hey, I'm up at the value area high. Let's make a decision to do something. But as soon as the point of control shifts up, now it's too close, and we stop looking. All right, so these are the two locations where we look: value area high, value area low. There's a third one, which is a low volume node. Okay. When we look at these locations, there are specific price action patterns that we're looking for that then trigger a machine learning prediction. Okay, so price has to do something. It's not just I get to the edge and I start making predictions like crazy. The market's too random for that. So we're looking for specific patterns of price action that help us indicate that price is going to do one thing or another. And then we tell the machine learning system, hey, look at the last 2 years of data and find order flow that matches what you see here in these bars, and then tell me what to do. Okay, so every one of these numbers here is I found a price action pattern that indicates I should make a prediction, and then there's the prediction. All right, if it's a 3-digit number, then it's a prediction to actually do something. If it begins with a 2, it's a short. If it begins with a 1, it's a long. If it's a single-digit number, and note it's .00, so 2 is a single-digit number here. That means don't do anything, and that number is more for my debugging. So I understand where I am in my in the program. All right, so these are 1s, and these are 2s. So different parts of the program are engaging the machine learning system. Those are debugging codes. All right, so single-digit numbers don't do anything. 3-digit numbers do something. All right, so what that means is that this bar here, there isn't a price action pattern there that the system thinks you should be making a prediction at. All right, and there's a very specific reason for that. I could spend some time and explain exactly why, but we're not going to do that today. The point is there's a requirement before the machine learning system will kick in. And it's a requirement that was developed really sort of prior to this concept of targeting a location based on volume profile. All right. And what we see is stuff like this, where the market you see these bars are orange. They're orange because for a different reason, and you see the market is just blowing right through here. All right. So the third location where we will look for a trade is what's called a low volume node. All right. So this is the value area high. This is the value area low. We're going to look there. We're also going to look at all low volume nodes. So let's describe a low volume node, and to do that we got to go back and look at the volume profile. So here's the volume profile at the end of the day, and do you see how the volume profile shows this here? You see this valley in prices? This price level right here, 74.10.50, has the lowest volume of any price level in the neighborhood. Okay, this price level up here has the lowest volume of any price level in the neighborhood, and also right here, though it's hard to see, it's harder to see that one because it's in the midst of bigger volume. All right, so basically it's comparing the way that algorithm works. It's comparing the set of prices like 20 above and 20 below. And when it finds a valley like this, it highlights it. Now, from a volume profile theory perspective, let's think about what that means. When the price was trading at 74.10.50 at this level right here, not much volume traded there, which means the price did not stay there very long. So it could only have done two things if it didn't stay at that price level very long. If it stayed at that price level very long, you'd have price action that looked something like this, right? It would have had to have stayed there for a while to build volume, but that didn't happen. There's very little volume there. So instead, one of two things happened. Either it just blew right through it, or it bounced off of it. Okay? And so let's just walk backwards and you'll see a bunch of examples. Let's go back to Thursday though, because Friday was so active that it's crazy. That's Friday. No, I went too far. Okay, so here's Thursday. Let's go back to the day we were looking at. So right here, what I have done is written a custom study that tracks the low volume nodes throughout the day in the same way that the native Sierra chart study tracks the value area high, low, and point of control. Okay. The built-in study doesn't do that. Nobody does that. And so these red and orange lines represent low volume nodes at that point in time. Okay. And for each bar, if there is one present, it'll show an orange line for the low volume node that's above the bar, and a red line for the low volume node that's below the bar. And all I care about is the low volume node that's closest to the current bar. I don't care about any other low volume nodes. There might be a whole bunch of them. There could be a bazillion low volume nodes up here, but price is down here. All I care about is where price is. If we get back up here, then I care. All right, and those low volume nodes will show up. All right, and so what you can see here is that there was a low volume node right here. All right, and it shifted up just slightly as the price went through it. All right, but it stayed there, and there's still a low volume node right there. All right, and that bar is orange because it got close to this low volume node. All right, and what I'm after is this particular problem that we see is that very often you get to a low volume node and it just blows right through it. All right, but the way that the price action patterns are constructed to trigger machine learning predictions will not do anything there because it's just a straight line of price. There's nothing to do. There's nothing to indicate that the market's going to continue or not continue. There's nothing. But if we add the low volume node as a piece of information, now we have something to work with. We know that this location, this price right here, 76.1775, and it was 76.1725. We know that's an important location, and it's important because price does not like to stay there. The traders don't agree that this is a good place to do business, and so we don't stay there. We either go through it or we bounce off of it. And the only way it changes are those cases where this happens to be the new place of equilibrium, and then the low volume node, it will go away. A lot of trading will occur. We'll see that happen here, I'm sure, as we look. So here, I want to make a prediction here as we get to this low volume node, because I really want to capture these cases where we just blow through it. All right. The other possibility is what you see right here. The market fell lower. There's a low volume node right there. It's a little hard to see because it's right on that Globex low line. All right, there's a low volume node there. Okay, and there's a low volume node here, which is really the same one. It's this one, but because a little trading occurred, it moved down. So there's this low volume node here, and you can see what happened. We came up to that low volume node and just rejected off of it. All right, and you'll see it happen down here a lot. Here, this level is set as a low volume node, right here. See the orange bars? And the market comes up to it, and it bounces off of it. It comes up to it, and it bounces off of it. It comes up to it, and it bounces off of it. Now, the actual price action here is not at all simple. This is almost an unusual case. It's quite often much more like this. Whoops. Much more like this, where it comes up to that low volume node and just immediately rejects off of it. All right, it doesn't thrash around at all. If it thrashes around like this, I'm fine. My existing system will work just perfectly. All right, it'll, and the reason is that you can see. What did I do? You can see a test occur. You can see a test right there. This spot right here is really important to me as a human and the system that I developed before. All right. The problem is, if you look back here, we don't get that test, and most of the time on the low volume nodes we don't. It just bounces right off of it or blows right through it. So this one I would normally just do fine with. This one, okay. You can see that. You can see a very similar thing happen. It comes up, it pulls back, it tries again to get through and fails, and I would notice that and take an action. All right, but this is happening only because the market is so crazy right now. All right, normally that's not what happens at a low volume node. Okay, it just blows through it, or it bounces right off of it, and you don't get interesting price action that helps you see that the market's not going to go through that low volume node. Okay. Larry is asking, what distance is too close to the point of control? I put 2 bars. Okay. What distance is too close to the point of control to take a trade? Think of it this way. This is a target. So the theory is more important than the implementation. This is a target. If I'm going to take a trade, I want to be at first target by the time I get to this spot. Otherwise, don't do it. So my first target is 20 ticks. You got to be 20 ticks away. Okay? And that gives you some wiggle room to get to, a sort of, a move the stop target. All right? So 20 ticks, 2 bars. All right. Let's see. I want to see if I can find it. These days we're so active that. All right. So actually, this here is a good demonstration of sort of the difference. This here is a very normal looking approach to a low volume node and reject. It heads up to it and immediately rolls over. All right. So previously we would not be able to do something there. This is because the markets are crazy. It goes up to that low volume node and it thrashes around. And if it thrashes around like that, I'm totally fine. Our existing method of finding an entry there will work. You can see these shorts here that are kicking off 251, 227. All right. But our dilemma is that that's not the usual case. All right. see if I can find some better examples here. This is a good example. You come right up to the low volume node and you just immediately bounce off of it. If you look at that price action, all right, that price action, there's zero, you have zero indication that the market is going to turn there. All right. And so you want, in this particular case, there's a level there that's breaking, which I am able to use to see that break is, I can trigger off that break. But this is very common. An advance to the low volume node and an immediate rejection. And so what I have done is changed or enhanced the system so that we can capture these cases where we bounce off the low volume node like that or blow through it. Here's another example right here. This is you come right up to this low volume node right there, all right, and then you just roll, you just reject off of it. Okay. You're getting a short signal there now, you'll notice. All right. Let's see. I want to find the other example here. This is a crazy amount of low volume nodes. The problem with doing this now is that you're actually sort of better off not using what I'm describing, because there's enough activity that you don't need it. Here's another case up to the low volume, and you just immediately reject off of it. Pretty classic move back to the value area low there. This is the other example. Do you see that? So under normal conditions, I would never consider to do anything right here. And yet there's a low volume node right there, and now I know that this level is important. And it's either going to reject or bounce off of it. And so I want to catch these cases where it blows through it. All right. So what the system does is for the bounce cases, it uses a much simpler price action pattern requirement. All right. So all it needs is a single bar in the opposite direction. You see that? Actually, you use 2 bars to establish direction, and then a single bar to bounce off of it. And that 1.0 means the low volume node portion of the system says make a prediction. Okay, the prediction came back, don't do anything, but that's what the 1 means. Okay, if that number is a 2, that means the normal, more complex price action pattern was detected. Make a prediction. Okay, when we're blowing through these levels, I want to make a prediction here, all right? But there's some caveats, all right? Like here, there aren't any number ones here. Well, and you might ask yourself, well, why not? I'm at a low volume node and I am blowing through it. Should I be doing something there? And what testing showed is that when you've got this many bars in a row, don't do anything. You're much more likely, even though there's a low volume there, you're more likely to pull back before you continue higher. All right, so there is a requirement that says if there's more than 4 bars in a row without any kind of jog, don't predict there. All right, that's why there's no 1s there. Let's see if we can find an example where we actually blow through it. Yeah, right here. So here we reapproach this low volume node, and the system goes, okay, well, I see 3 bars in a row going through a low volume node, make a prediction. All right. This is really intended more for this case here. but I see this case happen here as well, where the market it kind of blew past the low volume node, thrashed around a bit, and then came back down to it, and now it's going to just blow right through it, going the other way. So if we didn't catch it up here, we have another shot at it here. Okay. So Jay is stating that using the area in the middle between the value area high and value area low is not a good place. It's too risky to enter a trade. That's the philosophy we're implementing, except if you are at a low volume node. So if you're inside the value area, then the only time I'll take a trade is if I'm at a low volume node inside the value area. And the low volume node is, by definition, I didn't spend time here. So you can actually sort of see it happening right here, right on screen, right? This is at the end of the day. This low volume node is sitting right here, all right? And the price blows through it, and then the price bounces off of it, all right? I guess it would be more like this. The price bounces off of it, and then it blows through it again. All right, so those are, to me, those are reasonable places to take a look, all right? And in fact, if you remove those, you lose a lot of opportunities. So I did that testing. All right. If you say, okay, I'm just not going to get in when I'm inside the value area regardless, then you miss a lot of good opportunities. Okay. So the low volume node is telling you, hey, take a look. This is a place to look at. All right. And what I like about it so much is that it automatically adjusts, right? As the low volume node, if price trades at that price level, it's not a low volume node anymore, and the system will just automatically start ignoring it. Okay, so to implement this, if we go to the spreadsheet, you have a normal set of codes that you're used to using that represent the different price action patterns that the machine learning makes predictions on. Okay, so this should be very familiar to everyone that is a member. All right, there are now 8 more. Okay, that you can make use of, that are specifically for low volume nodes. Okay, and what they are there's, if you think about it, there's 4 cases. All right, there's approaching it from below and bouncing off. That's case number 1. Approaching it from above and bouncing up, that's case number 2. And then there's blowing through it, going down, that's case number 3. And there's blowing through it, going up, that's case number 4. So you have a code for each one of those cases. And in other words, let me rephrase that. For each one of those cases, there's 2 codes. One is that I am going to successfully bounce off this to the short side, or I'm predicting that bounce will fail and you're gonna continue higher. Here I am predicting, yes, you are going to bounce up and keep going higher, or your bounce is going to fail and you're actually going to roll back over. Same thing for the short. I'm blowing through this. I predict you are going to continue to go down, or no, the order flow suggests that this attempt to blow through the low volume node will fail. Okay, and the same thing here. Successfully blowing through it higher or failing. So that's why there's 8. All right, and this will be explained in the exactly which code does what. It will be explained on the updated sheet that'll go out when you download this package. Okay, now this requires a server update. All right, so what you'll see on the download this week is the normal models, and then in the server and chartbook sections, you'll see a package that says low volume node package, basically. All right, and in that package, it has new chartbooks and a new server. All right, I'll put out a video to help you understand how to install that. It's the same installation you've always done. It's just I want to make sure you understand, if you use this new chart book, you've got to be using the new server or it's not going to work. Okay. So look for that video when I publish these chart books. Okay. Let's see if there are questions. No questions. All right. So we have as part of that package, we have a spreadsheet that shows what all these codes mean. That spreadsheet will be updated to include these 8 low volume node codes. Okay. Now, there's something that's we really got to talk about, because the idea behind what we're doing, the larger philosophy of what we're doing, is find a good location and then take a look and see. Use the machine learning system to figure out, do you want to enter there or not? All right. And so at the edge and at low volume nodes, they're sort of exactly what we're looking for. The problem is that this level of volatility is so high that you've got low volume nodes popping up everywhere because the market is just whipping around back and forth. Okay, so it helps a little. It helps a bit. It helps more than a bit to keep you out of trouble in these crazy times, but it's not a perfect solution to, hey, the markets are really volatile, I'll just use low volume nodes and now I don't have to worry. All right, I can show cases where you would be better off. In fact, it happened on Wednesday. You would be better off not using this low volume node processing because too many are popping up because the markets are so crazy. So something that we don't want to lose sight of, all right, is that while we have had truly unprecedented volatility since February, this is not the normal case. The normal case is much lower than that. Okay, and so I'm working very hard to make sure I don't optimize to these conditions, and then when it goes back to normal, nothing works. All right. With that said, this volatility is so high that if I wasn't using a machine learning system, I would likely not be taking any trades at all as a human. It's too crazy. It's too hard. All right. So one of the things that I have not done yet but need to do is update our volatility guidelines that state, when do we start? What codes do we use, and include whether or not you should or shouldn't use low volume nodes. I don't have the data for that yet. All right, but I can make an argument philosophically that when the market is this wild, you're much better off not using these codes. You don't. In other words, you don't need them because the market's thrashing around so much. You don't need a simplified price action pattern. You actually want to avoid that. Okay, so it's something that it's very important to keep in mind. All right, because I'm releasing this. It's new, so new is better. I should use it. Yada yada yada. That's not true. Okay, because the market is this dynamic thing, and it takes time for me to develop something. And once it comes out, and in the meantime, the market's doing its thing. In this case, I can make a strong argument that you just shouldn't put those codes in. Install everything and take those codes out, and everything will just work like normal. All right. So to be clear, if you installed everything that I have, or if I take like the system that I have right here, if I just remove these codes, well, that's just like normal for what we've been doing. Okay. And so this is the thing to be thinking about that I don't have an answer for you yet. When is the market so volatile that you're better off taking out those codes as opposed to keeping them? All right. I know from data for a fact that when the market is quieter or normal, that it's much better to include them. All right. I've seen cases where when the market's really crazy and volatile, it's better off to exclude them. But that's anecdotal. That's not a scientific study. All right. So with all that in mind, I'll release this, and you can include or exclude it at your convenience. All right, based upon your discretion. The other thing we've been doing recently, this is changing topics now. The other thing we've been doing recently is getting much more conservative with our limit entry offset because the markets are so crazy. I was getting nicked a lot the last few weeks, and as a result, I did a study and changed my limit entry offset to 5. Okay, and it worked out. You could either keep your 10 tick stop or use a 15 tick stop. It didn't matter. And it's watching that work. It's interesting how it will sometimes prevent you from getting into a trade because the market doesn't move back enough for you, and other times it just keeps you from taking trades that would just scratch out, and you're just burning costs. What it means is, if you think about it, what it means, a limit entry offset of 5, it means the market basically has to thrash around a bit at your entry, and that's what we've been seeing. We've been seeing, I'll get a signal to get in, and I'll place an order, and the market is just sort of immediately popping back down before going our way. So I've been happy with what I've been seeing using the more conservative offset. It's the same thing. We need a more rigorous study. To understand what's best. I did that last Friday's video, but it was only on 1 week's worth of data. We really need to do that on a bigger set of data. Okay, so Dave is asking clarification here. So there will be new models like there are every week. That's normal processing, okay? You can just use those new models with your existing system and everything will work just like it always has, okay? You can also download this new server and chartbook package and use it with the same model and start taking advantage of, or considering taking advantage of, low volume node processing, okay? And if you want to do this, if you want it to be the same, then you would just install the new system and just take out these 8 codes, okay? That is identical to what you're using now, okay? So there's no rush. If you're not going to use low volume nodes, there's no rush to do it. You can take your time making it work. It's just the new chart book won't work with the old server. It just won't work. You'll get an error. Okay, so if you want to use the new chart book, which includes low volume nodes processing like this, then you have to have the new server. Is the point there. So what we're doing today is we're looking at low volume nodes and the edges for places to enter, but the low volume node look, it requires the same complex price action pattern at the edge. All right, and really what I'm doing today, or this weekend, is releasing simplified price action patterns at the low volume nodes. So you have a different. You'll basically get more looks at low volume nodes than you would before. Okay, but like anything else, since the market's crazy right now, more may not be better because it's too noisy. All right. So what we normally see on a day is the markets will trade and the low volume node will show up and you'll move up to it, and when we get there, we really want every opportunity to take a trade at that low volume node. Right now, the markets are making 40 point moves in a direction and reversing immediately, going the other way. There's no time for any sort of volume to build in a normal volume profile. And so low volume nodes are sort of popping up everywhere, and they don't, in my view, in the current volatility, they don't have as much weight as more normal times. All right, so, and the line may very well be this yellow line I drew right here. This is the average daily range. And this is somewhat anecdotal. It seemed more, if you got below 80, then it was the trading was more reasonable. It wasn't so crazy and whippy and wild and fast that you felt like you were, riding a bucking bronco. Whereas above it and certainly above 100, it's just the markets are crazy. All right, definitely be cautious. This is hurricane levels of force out there, and for us small account traders in our little boats, we're capsizing and sinking. Okay. All right. So what you can expect this weekend? Normal models will go up. You'll see a message for that. And then I will upload a package that includes the server and the chart books for what I've been, running live here testing the last few weeks, along with a video on how to unpack and install that. There's nothing new there. We'll just put it all together to make it easy. And then also an updated. There'll be two updated documents. One is this is Pacific time zone, my chart book, and so there's a bunch of places where you've got to change your times because of that, and there's a document out there that describes that, but I missed one spot, so I'll update that. And then there's a spreadsheet that shows all of these different codes, all of these codes down here, and I'll update that and send and put that out there. So they'll be in the normal documents place on the download, but they'll also be in that package. So that's all just in one spot. So you can you don't have to go hunting for things. Okay, and that's what's going to go out. That'll go out late, probably pretty late Sunday. That's a lot of work to do and then to test to make sure that it's all packaged correctly. And I'm looking for questions. Last chance here. We're well past our time, actually. Okay, so thanks for your time today, and then look for all that. And then members, you'll all get messages that I just described. And I will see you. So look for that, and then I'll see you on Monday in the trading room. Take care.